Good evening, everyone. I hope you're all doing very well. Very best of luck to everyone. Firstly, in 2023, our first market review video of the year. Getting stuck into the price action for the first couple of days of this week, of course, after the bank holiday for New Year's. In the aftermath of Wednesday's FOMC minutes, in terms of the market volatility today, and of course a preview ahead of tomorrow's NFP payrolls, which will be coming out at 1:30 UK time, should I say. So as we said, very best of luck to every trader who are taking challenges with us, even our funded traders as well. And of course, for those who have taken previous challenges and are maybe struggling with the risk management side, feel free to reach out to us too, because we are supporting traders in 2023 by doing risk reviews. So of course, any support that we can give traders to allow them to get the most out of their trading, we are obviously more than happy to do that as well. So without further ado, let's take a look at the price action for the first few days of this week. We'll then take a look at the news tomorrow for NFP, taking a look at some of the information for that. And then we'll look at the markets broadly. So we'll look at gold, we'll look at the indices, and then we'll also finish off by taking a look at some of the FX pairs as well. So firstly, this week, the big, I suppose, talking point was really from the 19th, 20th of December, right through until the 4th, 5th of the year. Up until really today, maybe Tuesday, and to a lesser degree as well, markets have been fairly consolidated. We did expect that. We weren't really expecting much. The dollar, broadly speaking, during that time has been very stuck and consolidated between effectively 103.50 and 105 to where it's currently testing the higher levels of the region for the last nearly month or so now, or just a little under a month, from around about the 10th, 12th, 13th of December. So that's effectively where the dollar has been over the last few weeks or so. If you look at the dollar in the broader echelons of markets, we had that massive run up through Q1, Q2, Q3 of last year. Q4, we had that massive unwind back into this level again. So I suppose the next few weeks are really, really going to be important to determine whether we do see the dollar continue to pick up strength, we do see the indices to continue to remain in the backbone, or whether we see a more moderated movement in the markets after what's been, as I said, a very, very turbulent and volatile 6 months or so. Now, I suppose from a shorter term trading perspective, from those who look at the lower, even the lower time frames, even not below the 4 hour, but even the 1 hour, 30 minutes, etc., you can see broadly as well how the markets has been fairly consolidated for the last number of weeks or so, particularly even from those early December highs, which of course came in at 105.50, but more broadly these local highs in here around this 105 level. So that's really going to be important over the next few days, because of course, if you look at the price action, you can see on the DXY we've had consistent bearish trending order flow. We've had lower lows, we've had a pullback, we've had marginal new lows as well, taking out the bodies, albeit not the wicks. Another brief pop back up, and the markets trended lower all the way into this deeper consolidation. So that's really kind of now where my focal point is this week, to see how does the markets react. Obviously tomorrow NFP, you're going to see a little bit of volatility from a fundamental perspective, but just waiting to get those breaks. You tend to want those breaks of structure, you tend to want those initial impulses, because that's of course setting a little or a short-term directional bias in the markets. Then you'd be looking for the mitigation of order blocks, and you're looking for those liquidity moves, those liquidity grabs, should I say. And then you're looking for those trending price action structural moves over, let's say, 1, 2, 3 weeks, broadly speaking. So at this moment in time, the DXY Tuesday had initial run up from that 103.50 level all the way as high as kind of 104.80. We then went consolidationary yesterday, even despite the FOMC minutes. But today, from 11, 12, 1 o'clock, we started to see that dollar strength come through. We started to see that index weakness come through. And dollars picked up today into the US session open. Indices have been very much on the back foot, and we'll talk about Dow Jones and S&P and so on in a moment or so. So that's effectively where we are now. I suppose from this perspective, you really want to see structure. You want to see price action breaking through. Now, from your short-term trading perspectives, if you trade ranges and if that meets your criteria within your trading plan, that's obviously fine. But for the trend traders, for those who like to see kind of clear structure develop, you tend to want to see those breaks. You tend to want to see those initial impulses, as I said, the mitigation of the order blocks. At least that way then you've something to work with, rather than trying to trade nearly for the sake of trading. I think that's really, really important as well. Making sure there is validations within your trading plan to do what you want to do. If you're not seeing those setups, well, then you have to question, is it worth taking the trades that you're taking? Okay, for those who are failing challenges or verification or valuation accounts with prop firms. Now, again, I suppose with the DXY, just looking to see, right, 105 has been rejected quite cleanly. Today, we've tried to break through it. We're now trading back underneath. And I suppose that's going to be a big thing now to see how does the markets react. Do we close back underneath that 105 level? Because that then effectively means we're back into those consolidation ranges ahead of tomorrow's NFP. So that'll be worth keeping an eye out on the DXY and those cross-border USD pairs, broadly speaking. Now, next on the list is gold. Now, if we look at gold, what has gold done? Well, it's that continued chug higher has continued to play out. So, of course, we had that Q2, Q3, and Q4 sell-off all the way into October before we started to see that market recovery in November. December, we said obviously Q4 was the bottoming out. We've pulled all the way back up into this 1800, 1810 level. Now, that was a key area, short-term price action structure. And, of course, what's happened since then? Well, we've broken through. We've continued to create bearish order flow. We've continued to grind higher. And we're now mitigating all of this sell-off that took place between June, July, into the early parts or latter parts of July, leading from this 1870, 1880 level, is effectively being mitigated from the markets. Now, of course, you can see that out there. Very, very clean sell-off. A final wave of selling. Bottom comes in, and we get that gradual grind, gradual assimilation back up into this level. Now, when we look at the last, let's say, 3-4 days of price action from maybe Tuesday, Wednesday, Thursday this week, well, into year end, we've seen dollar remain very much bid. And through the early parts of this week, we've seen the dollar remain, or gold prices, should I say, remain fairly much to the upside as well. We've come to 1866. We have now come back down into the high 1820s. Now, when we look at the shorter term price action structure, what are we still seeing? Well, we're still seeing bullish order flow. You can still see it there very, very clearly. Higher highs, higher lows. Marginal highs again, new higher lows. Marginal highs again, new higher lows, and then the price action very, very aggressively breaks up to the upside. So now it becomes a case of, well, if you're looking at this as an impulse and you're still looking at buying, well, then you really should be looking at buying from liquidity areas. Okay, if you're looking at the last selling area, well, you've last selling area here, you have a brief wick, you're coming back in, your last area of order flow is really coming in here around 1810. Right? If you look at it roughly, you've got maybe a couple of wick candles, smaller ones in between, but this is a nice healthy one. Last selling candle before the buying comes in is really in around this kind of 1805, 1810 range. So if you're still looking at buying, you're still looking at bullish order flow, you're still looking at saying, well, I like gold to go much higher, well, then you're probably looking for that correctional move back into this liquidity area, mitigate this buy side imbalance up to 1860, 1865, look for the mitigation, and then kind of target this zone, right? That's probably what many traders should be looking for, could be looking for within these markets. Now, if you're looking at the Fibonacci structure from recent swing low to high, that comes in very, very nicely as well. You've got the 61.8, you've got the order block zone, and you've got 71,707 to 786 direct numbers, direct region down here as well. So you've got some interesting levels here to play out for. I think on gold, that'll be one to kind of keep an eye on tomorrow, because we know, traditionally speaking, gold at NFP can become a mover, without a doubt. So even for tomorrow, if there was, let's say, maybe a sell-off in the markets, gold sells off, rejects this level, and then you start to see the markets rising, well, then obviously the NFP was the catalyst to do the pullback into the liquidity area. And then, of course, you're getting that gold assimilation to the upside. Now, whether that plays out or not, let's wait and see. But worth keeping an eye on those gold orders around 1805, 1810 to see if there is any sort of reaction in this region, broadly speaking. So that's kind of gold at this moment in time. Now, until you get a break of structure, the only reason you would be looking at selling is either if we get a clear rejection off of this 1875, 1880 daily level, or whether this bullish order flow that's been playing out breaks. And of course, then really what you're looking for, well, you're effectively looking for all of this bullish order flow to be taking out, get a break of structure, flag back up, and then you're looking at that type of move if you were looking at selling from a clarity within the price action structure. And I think that's really, really important at present time. Now, when we look at indices now, moving across the indices before we look at the currencies, What has the US based indices done over the last 2 weeks? Well, broadly speaking, from the Wednesday before Christmas, the 21st, 22nd of December, really not a whole pile. We had that consolidation. We talked about it. We had the inverse of the October CPI. So this was the October CPI. This was the December CPI. We then had the FOMC, Bank of England, ECB, fundamentally all driving the indices lower. Then we had the bottoming out, and then obviously into Christmas week, between Christmas and New Year. And of course, the first week of the year, price action in the S&Ps and price action in the Dow Jones, which is just loading now, hasn't really done that much, right? You can see it there. Dow Jones has been fairly consolidated in this highlighted region. I just kind of drew out the region just for clarity so people can see that. But broadly speaking, what has the market done? Massive run up, initial sell off, price action still remains fairly flat. Now, I suppose if you're trading order blocks, you're trading liquidity, you would still be looking for kind of one last impulsive move, take out this order flow, and then see it maybe spiraling back down. But because the price action has been fairly conducive to this consolidation, particularly in a lot of these assets, it makes it quite tricky, because then you're trying to look at the broader ranges, the broader areas of interest. And you see it here as well in the Nasdaq. But broadly speaking, in the S&Ps, you can kind of see it there. If you were to draw out the range, structurally speaking, 3,900 highs, around about 3,750, 3,770 is your local lows. For the last 2.5 weeks, markets have been up and down in a range. And what you'll even start to see now is you're starting to see on the shorter term parameters, lower highs and higher lows. You're seeing lows here, seeing highs above it, or lows above it. You're seeing lows above it here. So the markets is becoming increasingly more consolidated, increasingly more congested within, I suppose, if you wanted to draw it out, within these two broader arrows as well. So you're really looking for some sort of reaction here to see how does the markets develop, because of course, yeah, fair enough, if you're trading the short-term time frames, you can get away with trading ranges. But if you're looking from a higher time frame perspective and a trend trader, you really need to see some sort of movement, whether it's higher or lower or in some sort of way, shape or form. Now, I suppose if we backtrack for a second on the S&Ps, very, very quickly, and just remove both of those levels, you will also see as well the October CPI, the short-term taking of liquidity, taking of highs, taking of lows, highs, back into liquidity zone in the S&Ps, and then we trend higher, all the way back up into this 4-hour order block liquidity zone from September, mitigates it perfectly, and we see the exact opposite. We take the highs, we get a very, very sharp, deep runoff into this 3,800 to 3,900 range, broadly speaking, and now the markets are moving sideways. So naturally enough, you would like to see the markets get back up to 4,000 to mitigate this impulse here from around the 14th of December, mitigate this selling breakout, get back up, take the liquidity, and then run off back to 3,600. However, we do also have to be recognizing of the fact that that may not happen. And of course, we then have to just look at the fact of, well, this, as we speak, is in consolidation. So therefore, we just need to be recognizing of that. Now, the best way to trade that is by setting alerts above and below, right? That's generally speaking the best way to recognize a break of the range, is by having alerts above and below the region. At least that way, if it breaks higher, you can see it logically. Well, the likelihood is it's probably going to come back into here. And if it takes out these lows, it'll effectively mitigate this run up here from November. And the likelihood is it'll probably try and take out some of these higher lows from this impulse here, and this potential decisional area down here at 3,600. So it's worth keeping an eye on the indices this week. However, just be wary of this moment in time. Very sideways, very consolidationary. Nasdaq, very, very similar. Although deeper in nature, we've had the consolidation, taking of highs, very, very sharp reversal, all the way back down to this 4-hour price action structure, although there is a 1-hour order block down here, and that was mitigated perfectly on the 28th of December. Since then, Nasdaq has just continued to run sideways. We're rejecting that 11,100 level. We are bouncing off 10,700 quite cleanly. Every time we've come off either one of those levels, we have gone in the opposite direction as well. So I think it is important to be able to separate the wood from the trees, be able to have clarity in the price action. Otherwise, you're potentially buying the high, you're potentially selling the low of the range, only for it to go back against you and revert back into the range that has derived from. So that is the Nasdaq really at the minute. Again, similar scenario really is just to see how the markets develop, because of course, what have we seen? Well, over the last few months, very, very tame Nasdaq recovery, rejected up here around 12.1, And of course, as we said in December, we had that very, very deep and sharp sell-off. 16th, 17th, 14th, 15th, 16th of December, all the way into Christmas, where we've been tied here between Christmas and New Year. Now, that would really be the most important point here is, well, if we do start to see 10-6 going, that could put pressure in the indices, that could put pressure in the tech stocks, particularly the likes of Tesla, Amazon, who of course this week announced that they were letting off 17,000 members of employees, should I say, much higher than what was expected in the markets as well. So it's important to kind of keep an eye on those fundamental events as well, because the news in those individual stocks, particularly the higher composition weighted stocks, will affect those indices that they are combining. If you want to go into Slick Charts or Market Screener, it will give you a breakdown of the composition of each of the stocks within each of the indices and the percentage weighting that that stock has within that index. So that is really, really important as well, particularly around earnings season, but again in recessions regarding job loss, stuff like that, because that's important. Moving across then to the Dow Jones, as we said, very, very sharp runoff into this consolidation. Deep rejection off the daily 875s, very, very sharp sell-off back into this zone. We did get a daily break of structure, of course. However, price action since then has actually been reacting very, very nicely off this level. So this was previously a daily break of structure line. Of course, you can see it there. We did get the breakthrough. Of course, we would have been looking for that move back into kind of 34,000, 33,900, somewhere up into this region, mitigate the order flow, and then look at maybe that deeper decline. However, if we look at the price action, 33,450 to 500 has been acting as an important price action level. So, of course, it's been supported. Now it's been resisted. So there is a bit of a support come resistance price action structure there playing out at this region. Now, of course, if you look at the 4-hour structure, what are we seeing? Well, again, back and forth. Markets had found a bottom just before Christmas at 33,400 to 500 level. We did get that rally back up to 33,400, 500. This region up here, the high of the range. And of course, the markets has now again consolidated at this 32,800 level. So we're seeing shorter term structure as well, particularly if you dive down to a 1-hour chart, look at the range, you can kind of see this shorter term price action bottom playing out. Markets sold off today, has found a bottom at 32,800 and is making a modest recovery. However, the overall narrative is that the price action is still very much in consolidation. So me personally, as you can see there, I have alerts set up here at 33,955, 34,100. So really this becomes the area of interest to see, well, if we do get back up into this zone, could this be a potential anchor point for potential selling? And that will be one to keep an eye out on over the coming weeks to see how does it play out, because of course the 33,955 comes in roughly around the 61.8 and the 34,100 comes progressively above that up at this region here. So this really would be the ideal level that if we could get back up to there and we start to see that rejection, that fade the rally in the Dow Jones and then look for that unwind, because of course if you look at the broader perspective, we've got buy-in all the way up, break of structure, very, very sharp daily rejection, daily order block rejection, then the break of structure to the downside. So of course if we could get that mitigation here for an unwind, that will be a very, very nice potential clean runoff for 2.5, potentially 3,000 points if we were to get that zone of interest. So that's the Dow Jones. The rest of the indices, again, the Dax has been European indices so far this year has been quite incredible, because of course we talked about this in the Dax before Christmas, that were kind of rejection up around 500, 550. We did have that break of structure. So of course we kind of looked at this saying, well, we've obviously got bullish order flow. We've got the break of structure. We flagged back up, took the highs. That deep runoff price action came all the way back up into this zone of interest. So really now from a short-term trading perspective, it's just a case of, well, we've grounded higher. We've taken liquidity. We've had that very, very sharp sell side imbalance into consolidation. We've mitigated this sell side imbalance, or most of it anyway. And really now it's a case of, well, how does the markets react? Because of course there is some potential clues here that we could start to see indices roll over. If we start to see S&Ps, Nasdaq, Dow Jones break some of those consolidation ranges, that really does pose well, or bode well, should I say, for indice weakness potentially in Europe as well. Now, at this moment in time, DAX is kind of laboured here, fairly consolidated today around this 14,500 level. It looks to be kind of consolidating short term. You can kind of see it there as well. Initial peak Price action coming back up, rejecting this level again on the 1 hour. And even today at 3 o'clock, very, very sharp spike back into the local highs of 14,500 and fading again. So really that's kind of a short-term intermittent level here in the DAX to see whether that fades, whether that rallies. Anything above 14,500 really does allow for another probably 100 points higher. But if not, if it starts to fade, like we saw initially this morning, or the late morning, early afternoon today, that could be a nice little runoff. And similarly enough with the Euro Stoxx as well. Euro Stoxx, very, very clear move, broadly speaking, over the last few months, all the way back up into this 4,000 level, mitigated this kind of higher time frame level, bullish order flow, clear, sell side imbalance, breaking structure, both internal and the external, into this consolidation, and we flagged all the way back up into this level. Now, when you look at the 4 hour structure, you can kind of see it there as well. 4 hour structure is quite interesting because, of course, we have the, I suppose, the internal structure. You can kind of see that playing out quite nicely. Internal structure has been broken into this consolidation, rallies back up. So, of course, if you were to integrate the fibs again with this one, draw it out very, very quickly. You can see it as well, right in this key level. Okay, that's quite an interesting one here. 39.50 for 39.80 is a very, very interesting one. And kind of Euro Stoxx now, it's coming really, really interesting because, of course, yes, we could rally through 39.80 and push higher for another 20, 30, 40 points. But really, this is an interesting level to see. Is there any sort of reaction? Of course, as I said, tomorrow we do have NFP. And that lastly brings us in the indices to the FTSE. And the FTSE has continued to remain quite strong, mostly because of the continued weakness in the pound. So you're seeing euro pound grind higher back to 90. We're seeing cable come under pressure. We're seeing a lot of those pound pairs come under quite a lot of pressure. And that, of course, is affecting the broader dynamic in the markets because, of course, the FTSE and the pound generally have a negative correlation. So if the pound is weaker, the FTSE tends to do a little bit better. And then, of course, when the pound bottoms out, that weakness, and we start to see that filtration of strength back into the pound, it then starts to mean that the FTSE lags somewhat. Now, albeit today was a really, really important day because, of course, today was the first day that we've taken out those 30th of November highs around this this kind of level up here around 36.30 or 76.30, should I say, because on the daily time frame we've been very conducive. We had that initial runoff back to 7,300 had a nice poised bounce, and of course since those mid-December bottoms, the markets has rallied another 300 points. But of course, on the broader perspective, if you look at the last year or so, we're only back to the kind of local areas, right? This 7,600, 7,700. You only have to draw a range of interest to see how many times has the markets reacted. Right? We sold off at numerous times. If you go back out to the pre-COVID times, of course, this was one of the only indices never to make a new all-time high during 2020 into 2021, before we had that sell-off last year in 2022. And you can even see here as well, above 7,700, there is a runoff or run-up zone as far as 7,800 to 7,900. Now, do I think it's going to get there? Well, that's going to be incredibly interesting. We've had an incredibly bullish week this week. We had a fairly tame week, obviously, at the end of the year. And the 19th of December, that week was quite strong. So it really just becomes a case of, does the momentum in the FTSE sustain? And of course, can they get a weekly close above this 7,700 level? I think that's going to be the big talking point over the next couple of days or so. Really into tomorrow's NFP. We've got some European data out as well. So just looking at all of these narratives, because of course, if the indices sell off, generally speaking, the others tend to follow in sympathy. So just be aware of that. All right. So that is the indices. That's gold. Just a quick view recap of the DXY. Now, I suppose tomorrow we do have NFP, right? So NFP, non-farm payrolls, unemployment rates. So if you're looking at the Fed minutes from Wednesday, you're looking at the Fed interest rate from mid-December. The big talking point was that they were expecting the unemployment rate to increase in the States, not dramatically, but quite significantly over the next year or so. They've talked about 4.5%, 4.6%. Considering where employment is now, if you take the unemployment rate statistics in earnest, and you trust everything that's been given in terms of the statistics, they're saying it's 3.7%. Jobs openings is at 10.5 million, which has meant that the unemployment rate has remained quite resilient, so quite low. Even the fact that this recessionary mandate is obviously been talked about. So 3.7, if we start to see that going 3.8, 3.9 over the next couple of months. That's going to be really, really important. Now, this is the unemployment rate, or tomorrow's NFP payroll figure is from December because it's a month behind. So of course it'll be interesting to see how does the December payrolls sync out, because of course we've got federal interest rates now, very, very early February. I think it's the 1st of February. So February and March, there's two really, really important interest rates coming up by the Fed to see whether they go 25 and 25. Did they bring in the 50 basis point increase rates, or what's kind of the program for 2023? Right, 25 and 25 is the base case scenario. But of course, if the unemployment rate starts to go up dramatically, that could be seen as a more bearish indicator that maybe they're not going to raise rates as heavily as people may expect. Now, other figures to keep an eye out on is the participation rate, still remaining consistent at 62%. And of course, tomorrow's payrolls, non-farm is coming in at around about 220,000. So that's going to be something to keep an eye out. And of course, factoring that into consideration, the payrolls is private, the non-farm payrolls is coming in slightly higher than that, so it's just about to be aware of both pieces of information. Now, of course, tomorrow at the same time, 1:30 p.m, we do have Canadian unemployment rates, participation rates. Basically, the Canadian equivalent of NFP is out tomorrow also, so that would be worth keeping an eye out on, considering the Canadian unemployment is just over 5% at this moment in time. Now, tomorrow as well, we do have ISMs at 3 o'clock, and tomorrow morning we do have retail sales in Europe. We do also have consumer confidence, and we do also have harmonized consumer price index coming out in Europe as well at 10 a.m. So there's quite a bit of data coming out at 10 a.m. tomorrow. And of course, at 1:30 a.m., we do also have significant data out of the US as well. Now, if we very, very quickly just turn to the FX pairs, just kind of skimming across these very, very quickly. Firstly, obviously looking at Euro USD. Okay, that's the USD JPY. Just give me 1 second, folks, till I change that. If we look at the Euro USD, we can actually see very, very clearly, nice little reaction off of 107. Structurally speaking, daily order block over here is rejected at 107. Consolidation on the 4-hour structure has been fairly evident over the last week or so. You can even see it here as well, the last couple of weeks or so, fairly consolidated. And of course, last Friday, we did get that brief pop through 107, and of course, failed and has taken the lows out of the range. So we've taken the highs and the liquidity. We've taken the lows. We did get a pop back up to 106.30 today. Now, I did have orders myself and personally up here around 106.60 just to take the last of the liquidity. However, they did not get triggered. We did see the price action reject here on 106.30 and is now trying to move lower. So is this the sign of maybe potential weakness in gold, potential weakness in FX pairs against the dollar, maybe seeing dollar strength? Well, only time will tell. But initially speaking, we've taken highs, we've taken lows. Let's wait and see. Okay, Euro USD is quite interesting because, of course, on the daily, that daily break, rejection of 107 takes the lows, and of course there is that unmitigated daily level at 106.60, so worth keeping an eye on that one as well. But of course, you only have to look at how far Euro USD has ran in October, November, and through the early parts of December. Very, very aggressive run up from 95 all the way up to 107, 1200 point move in approximately 3 months, or just under 3 months, which suggests the volatility that is present within these markets. So worth keeping an eye from a bullish order flow perspective. Obviously, we've got price action structure here, rejection, breaks through, holds this area, supports it. Even where this orange alert line is, there's been a lot of price action structure here around 104.50. So that could be a potential runoff zone tomorrow if we see some dollar strength into the NFP. And of course, as we talked about cable, let me just load up some of these charts very, very quickly. Cable, we talked about euro, pound strengths. We talked about pound weakness across the board. You only have to look at the pound over the last, let's say, 3-4 weeks. Very, very strong run up in November, but December, very, very weak. January so far has also remained quite weak. Now, does that mean that we're coming for a retest of these lows down here at 112, 111, 114, some of these zones? Well, at this moment in time, we've had a very, very aggressive move in the cable prices back up into this 124.50 level. We've created bullish order flow. We did see that unwind. Now the markets is starting to grind lower and starting to stagnate here on cable GBP USD. Now, short-term perspective, you can actually see a bottom coming in here, short-term bottom today, this week even, is at 119. So of course, if 119 slips and gives way, you're really looking at 100-point intervals. You've got 118 here in this price action structure. You've even got a deeper runoff of 118. You've got a zone here around 116, 116.50. And then you're really looking at then undoing if the selling is really aggressive. All of this buying imbalance that we saw through November really looks to potentially become mitigated as the price action could very easily return. Now, if you're looking at the broader perspective, even over the Christmas and New Year perspective, or Christmas into New Year, the consolidation, broke structure, came all the way back up into this liquidity zone, rejected 120, 150, 121, very much to the T. And of course, the markets has moved lower. So, excuse me, a very similar move to that of Euro USD. And that's pretty much the sentiment across the board. Dollar CAD continues to remain quite sideways driven. 4-hour daily order block zones at 137, 137.30 still remaining intact. And of course, dollar CAD comes into significance because of obviously the correlation with Canadian dollar and oil. So that's obviously something to look at there as well. But you're looking at bullish order flow into consolidation, short-term break of structure, but price action is inducing more accumulation as we speak there at the moment. Dollar yen, interestingly enough, bearish order flow still continues to play out. Lower highs, lower lows, lower highs, lower lows. Short-term lower high as 134.50. And of course, a lot we see last week. And of course, into the early parts of this week, price action breaking through this 132 level as we made new lows at 130. Now, since then, again, like with any good trend, of course, the selling price action has eroded. Buyers are back in town. And we've almost come back up to where the previous selling phase of price action or selling cycle of price action originated from. And that, of course, is between 134 and 134.50, which, of course, as we can see, was rejected today at 2 o'clock. So really worth keeping an eye from a short-term perspective into tomorrow's FOMC or NFP, should I say, on how does the price action develop in this region. Do we take out this short-term high? If it does, you're really looking at price action, not only mitigating this selling impulse, but trying to mitigate this selling impulse as well, which is coming up into kind of this 137 ballpark figure. Dollar Swiss, really not too much to report on, still moving sideways at this zone of interest, has tried to break through 94. Between 92 and 94, it's pretty much been stuck for the last couple of days, or a couple of weeks, should I say. And of course, daily closures at 93.50. The Aussie and the Kiwi, again, is quite interesting because, of course, from the daily perspective, order blocks here between 68.25, 6900 still remaining intact. We had the bullish order flow, we had the run up, price action coming back in, fading again, and a fairly strong daily rejection today. So really not too much happening in terms of the daily time frames, the broader perspective, because of course the DXY has still remained fairly resolute, fairly consolidated in this region, as we talked about earlier. So that's pretty much where we are. Last but not least, in the Kiwi, again, I suppose Kiwi's maybe a little bit more indicative of cleaner price action, takes out the daily order block, has a structured consolidation, as now creating lower lows again, lower low, lower high, new lower lows again. Price action is fairly consolidated at the minute. But again, that's probably the least favorite because, of course, Kiwi can be a bit of a messy pair with lesser traded volume in that currency, broadly speaking. So that's where we are. Quite a lengthy call tonight, but a useful call, hopefully, nonetheless. Tomorrow, we will obviously be looking at the price action in the aftermath of the NFP. And of course, looking at the price action in earnest following the first trading week of the year. Okay. Have a great week, everyone. And we'll see you all next week for another market run through.